All right, we've got 36 minutes left to trade. Wall Street has been waving the warning flag about the national debt for quite some time, but when will people actually start feeling the effects of it? Billionaire investor Ray Dalio, who founded Bridgewater, the world's largest hedge fund, has been sounding the alarm lately. The Guardian posting this article about it back in February, and even back in September, a Wall Street Journal op-ed said that the debt crisis is coming. Now let's put the nation's debt into a little bit of perspective. According to the most recent economic data, the U.S. has approximately $37.5 trillion in debt. That is more than the debt of Japan, the U.K., France, and Italy combined. So just how urgent a problem is the nation's debt crisis, and how soon could it start truly impacting Wall Street and Main Street? Joining us now, Atlas Merchant Capital founding partner and CEO Bob Diamond, also the former CEO of Barclays. Bob, so good to see you. When does the debt, when does it come home to roost? What will it feel like and what will it look like?
You know, I think before I've seen this recent market move of the last couple of days, I think what I would say, Liz, is that it's definitely there. It's probably the biggest dark cloud on a very rosy scenario for an incredible economy in the U.S., inflation under control. But, you know, you just put the number up of 38 trillion. To put that in perspective, 8 years ago, for the first Trump administration through the Biden administration, 8 years, it's doubled. So it was just about half that 8 years ago. And I think the last 8 years have been pretty good for the economy. So what are we doing doubling our outstanding debt during a time like this? And if we don't begin to address it, you know, what's the end game? And so I think you're asking the right question. The current markets, if you look at the last few months, you know, some of the U.S. Treasury interest rates have actually come down. So it is financeable.
Well, weren't we at 4.7 on the 10-year, and now we're more like 4.3?
Yeah, exactly. I think it got up close to 5%, right?
Yeah.
And it's now down around 4.25, 4.30, or 4.6, whatever it is, 4.5, something like that.
Yeah, we'll put it up, but yeah, we're at 4.276.
Yeah, 4.25, you've got it right. I guess I was thinking of the 30-year.
Well, it's hard to.
But I think that's an interesting thing, right? So the 10 years at 4.25, I think the 30 years about 4.65 or 4.70. So
Closer
the curve is steepening, and you're paying more the further you go out the curve. And I think that's a little bit of a signal. If you go back 6 months or so, that curve was pretty flat.
So, you know, the trade deficit,
yep.
We look at that, and it's become sort of front and center during this trade war. And Donald Trump is very interested in hopefully kind of mitigating that and making it kind of more beneficial to the United States. But the process has been incredibly painful for the stock market. In fact, all of the gains that were made since the inauguration, where there was so much positivity, especially from the business community, it looks like a lot of that has been frittered away, and certainly the markets show that since the inauguration. So do you think that that is just, listen, we were overdue for a correction, or this is very serious and we need to get some clarity on trade?
I think we have to have some accountability on both sides. It's been a nice run in the market, so a correction's okay. But I think, you know, the focus on reducing government spending is absolutely right. There's clearly you know, waste there. But I think the process of which we're going through it, I think what people are saying is give us a bit more clarity, give us a bit more consistency. Let's make it a little bit more straightforward. But I hate if we lost the focus on cutting government waste. You know, you go down to Washington, as I did earlier in this week, and government workers are not working in the office. Most of them are in the office 1 day a week or 1 day a month or 1 week a month.
Yeah. This is what Elon Musk and Doge have tried to tackle as well.
Yeah, and I think in that process, so the overall focus on that is absolutely correct. We need to make the savings where we can. It's impossible that after 3, 4, 5, 6 decades of bill after bill after bill, it's not time to go back and evaluate them. But I think the process needs more clarity and more transparency. And I think what people are saying is this is the right initiative. Let's have it a little bit more clear.
Okay, well, if you start laying off mass numbers of people, those are people who join the unemployment rolls. The unemployment rate may go up. We have a lot more people who are in trouble, and they will stop spending. Not to mention that the consumer has been held up by the higher end, and the higher end sets its temperature gauge of how much money they have by looking at their portfolios, do they not? And if they see what they have seen right now, I mean, the NASDAQ is increasing the losses here. I believe we are making a new low on the session, down about, well, no, low of the session is a loss of 409. We're down about 326, so forgive me on that. But the Dow is looking at the worst week in 4.5 years. If they see, boy, I have seen my portfolio squished, are they going to say, psychologically, I'm not going to buy that, I don't know, Lambo, whatever, my yacht, et cetera? I mean, then you start to see a real impact.
Well, let's go to first principles. You mentioned if there are layoffs. We have to be exiting staff if they're unproductive, if they're inefficient. So it depends on the reason. I mean, just layoffs for layoff's sake, absolutely, you're correct. But if we are making the government more efficient, then that is positive. And if we're not making it more efficient, that's negative. On the other hand, if you look at the inflation numbers, around 3%, Fed's not too anxious. It's above their target of 2%, but 3% is not going to panic the Fed. And the labor market is still pretty tight. So there's a lot of good things out there. I think it's too early to declare whether this is a correction and it should be bought, or it's a sign of something bigger.
Okay, what are you buying? We teased your appearance with what is the sector you say is the best right now to invest in, keeping in mind that everybody's watching the stability and the strength of the financial industry.
We'll give the caveat that we believe ourselves to be experts in financial services, not necessarily a lot of sectors. There's two things that are incredibly exciting to us. We are investing and focused with a clear strategy at the consolidation that's going to happen with regional and community banks. You and I have talked about this, Liz, for years. There's 4,500 banks in the U.S., and consolidation will make them stronger and better competitors to the big four. So over the next 2 to 3 years, we think that 4,500 banks goes to something like 1,000 or 1,500. We think that the consolidation will be encouraged by the regulatory environment under this administration. And we think that the synergies coming out are really on the cost side, and that will come out with a smaller number of really strong banks.
And so you're saying play the arbitrage here, like look for the ones that seem to be ripe for acquisition or merger?
Exactly, the stronger ones. And then also in financial services, we're a big believer in digital. We're a big believer in blockchain. And Circle is an investment that we've made. It's a private company. There's discussion that it may become public this year. And I think if that does, that's a great opportunity for people. A digital version of the US dollar managed expertly and safely with their reserves. It's truly a stable coin. It's a digital version of the US dollar, and it's 100% within the regulatory perimeter of the US. So watch for that IPO down the road. If and when that IPO comes, we think that could be pretty exciting as well.
Circle. All right. Bob, it's good to see you. Thank you so much.